Good morning, everybody. Hopefully you had a wonderful weekend. We have a guest speaker today, and Jerry will, with a great idea for you guys, and Jerry will introduce him in the concept. Jerry.
Hey, thanks, Mike. Hey, thanks for being on the call this morning, guys. From time to time, Yep, can you hear me?
Yep.
Can you hear me?
I hear you.
Can everyone hear me? Hello, hello?
Yeah. Yep.
Yep, you can. Okay, you can hear me. Okay, so thanks for being on the call this morning, guys. From time to time, we do like to have some guest speakers on the line here. So the speaker today, we've had Jim Wolter and John Frazier from Legacy Tree Foundation on the call before. And so they have some good strategies. They've been friends of ECA Marketing's and helping advisors here for many, many years. And they have some great strategies to share with you guys on some income planning and some tax savings. So without further ado, I have Jim Wolter and John Frazier on the call, and they'll kind of walk you through their strategy and answer some questions at the end of the call today. So you can go ahead and take over the call, Jim, and introduce the strategies to the guys.
All right, well, very good, Jerry. Appreciate that. And of course, I'm glad to have my associate John Frazier on with us. Say hello, John.
Good morning, everyone.
John is the your go-to person here at Legacy Tree Foundation. He's the one connected with Jerry and Missy and Mike over there, and we'll be helping with case design and so forth. But we wanted to just share these ideas, and we're honored that 5Q's allowed us to share these ideas for us today, because we think it's a pretty exciting and a great opportunity to share some of these unique planning ideas. So thanks for all of you for joining us too. Our belief is that you'll see where some of these ideas can be beneficial to some of your clientele, which in turn is going to be helpful for you and for your practice. So a couple things just at the beginning here and knock out. Always got to do these couple of quick disclaimers. We're a 501c3 public charity, so we're going to be talking about some interesting concepts that I think can be beneficial for y'all, but it is through a 501c3 nonprofit. And so number 4 there, what we talk about will be our legacy plan. So these are charitable plan giving transactions as outlined in the IRS code. So they're not investments, they're not presented that way. We don't give legal, tax, financial advice, as always, you can hear that. And then we don't give securities advice when we're talking about securities or those things. And we're not available in every state. We're in almost every state. So when we speak with each of you individually, if and when we have a case designed to discuss, then we'll just confirm that. But we should be good in your state because we're in just about all of them. So that was quick and easy. Let's jump into a couple of the things here. Because we're probably going to be new to most of you, I think that it's good that I solidify a couple of points here at the outset. And I think this is important because this type of charitable planning needs to be part of the services you provide to your clientele. And so we're going to talk today about how and why, because obviously if you're going to be involved in it, you want to see where the benefit is for your client first and then for your practice as well. But the answer to that is that you do have clients that can benefit from this type of charitable planning. And so what I like to do is talk about why or why not you haven't been involved in this type of planning. And so before we get too far along in this, I like to discuss a couple of thoughts as to why you may not have included any type of charitable planning into your practice, because we found that a lot of advisors tend to have some initial reactions or thoughts about this type of planning, and sometimes the thoughts that might be incorrect. And one of the thoughts that you might be thinking is that, well, I don't have any high net worth people. And so this might not be, useful in my practice. But instead, we should be thinking, do I have clients who could benefit by reducing their taxes? Really, who doesn't want to reduce their taxes? Of course, with last year's, the 2018 tax changes, that helps most people get some tax reduction. But in our case, and what my point is here is we're not talking about net worth, it's about reducing taxes. And so for us, or really for you, it comes down to if you have clients who itemize their taxes, then this could be a good prospect for you to have this kind of a discussion. So it's not just your high net worth clients. Another thought that some advisors may have is that they don't have clients who are charitable or who want to give their assets away. And so that's a good thought. However, what we should be thinking is which of my clients might benefit by repositioning current assets in order to create maybe income tax deductions, capital gain reductions, and income for themselves and or for their heirs. Because most of the cases that we do are initiated because of some looming tax issues involving some of their current or existing assets. So it's not just donating assets to a charity, but repositioning assets to meet your client's tax, their income, and their philanthropic goals all in one scenario. And then the last point is that, a lot of people, or you might be thinking, well, I don't want to spend a lot of time learning how to do or offer charitable options to my clients because I need to get paid for what I do. I'm not a charity. I'm in business to help clients, but also I have to make money. And so our model includes compensation for you. We found that so much of effective and suitable charitable planning revolves around retirement planning, tax planning, income planning, efficient transfer of asset to heirs maybe, as well as the philanthropic or the legacy planning. So we believe you should be compensated for those services as well. And so we have a 7% referral fee built into our model. So that makes it something that can be worthwhile in your practice if and when it's beneficial to your clientele. So that's some of the reasons about, maybe why you haven't done it and some answers to those thoughts. But here's a couple of thoughts as to why maybe you should implement these types of planning programs into your practice. We've really found that if you're the trusted advisor of your client, then that client would want you to be versed, I think, in the most options as possible so that they can make informed decisions. I think it provides some nice credibility for that client, because whenever you have complete and unique information, it usually increases the trust and confidence a client has in you as the advisor, which obviously you already know that. But of course, that lends itself to the client being more loyal and confident in you. And then it tends to strengthen the long-term relationship you have, because in the end, having more and diverse information, especially in the philanthropic area, to me, it kind of insinuates that you're maybe community-minded or civically engaged in your area, and that tends to give the client, I think, confidence as well in who you are as their advisor. And so, and the last point there, of course, is if you're like most advisors, you don't want to have someone getting into your client's house talking about maybe some of these specific ideas that maybe you could be talking about to your client. And so that's why it's good to have these on your roster or your docket of products that you have available or programs that you have available. So our goal here is not to try to convince you that we should be a major part of your business. We know that we're just a niche of that, but in reality, we also know that this is a program that you need to have available, because there are certain situations where this type of planning can be the best option for your clientele in terms of reducing the taxes, creating income, and passing asset values onto their heirs more tax efficiently. And so I want to jump to another point here that I think is important to make sure we clear up on one more point, because I've kind of been mentioning here this type of charitable planning, and so what do I mean by this type of charitable planning? And I know that some of you, maybe several of you, are somewhat familiar with this type of charitable planning, so you'll already understand this. But for me, back in the day, I'd been in the financial services business for 16 years before I'd heard of charitable planning. And then now I've got 20 years since then. So, I was like everybody else. I knew how to make a donation to my church or make a donation to Salvation Army or something like that. And I knew you'd get an income tax deduction for that. You just write them a check, you get a tax deduction. That's pretty common knowledge. It's kind of like this idea on the screen there that if a client transfers $100,000 to any charity, then they're going to give them that $100,000 and they're going to get a $100,000 tax deduction. End of story. And everybody knows how to do that, I think. But today we're not going to talk about that type of a planning, not that type of planning, because really your client doesn't need us for that. They really don't need you for that. They know how to do that already. This is the type of planning where we're able to do a partial donation and a partial tax deduction combined with that income stream. So the difference is we're not giving the entire asset away. We're transferring an asset to a charity, getting a partial income tax deduction, and creating income stream for that clientele. And so, we've all heard it said it's better to give than to receive. Obviously, that's true, but it's also kind of nice when we're able to give and to receive as far as our clients are concerned. So when people do, in this case, when people do with this type of planning, since I've used that term, when people transfer $100,000 asset to us, they're going to get income in return. Income can be immediate, can be deferred. It's income that can be for themselves, could be set up in what we call a structured inheritance. A lot of people will defer the income so it can go to themselves later, and maybe with the intent of having it go to the kids when they pass away. And then one of the great tools of the income that goes to the client is that they can use a portion of it to fund life insurance premiums in order to replace the asset value to the kids, potentially getting the most to the kids in the most tax efficient manner. And so that's one of the great benefits of this type of planning, is that income side that's associated with it. Of course, there are the tax benefits. The main key here is to reduce current income taxes. I mentioned earlier that if a person itemizes their taxes, they could benefit from a tax reduction. The tax deduction also includes a reduction in capital gains when stocks or real estate is the asset that they're using to fund their legacy plan. In addition to a portion of the assets always removed from their taxable estate. So there's that as well. So remember, it's not just high net worth clients. Everybody likes to save money on taxes. Also, the tax deduction could move someone to a lower reportable income tax bracket. So there's even more savings there if it moves them to a lesser bracket. Some people use the tax deduction in such a way that can minimize taxes on Roth conversions that they may have done. Some people have just been able to reduce the taxes on RMDs. Some have actually been able to use the tax deduction to access qualified funds tax-free. So that's a great concept for talking about this as well. And then the final point is that the charitable component. So almost every case we do, more income gets paid back over time to the client, in addition to the tax deductions, in addition to the amount of funds that go to help charitable causes that the client may have an interest in as well. So it makes for a pretty awesome scenario as to how that works. So just to summarize, what is one of our legacy plans? It's pretty simple, just basically what's on the screen. A legacy plan is a simple transfer of an asset to Legacy Tree Foundation. Could be securities, annuities, real estate, cash. In exchange for that, they get the tax benefits that I mentioned. They get the income tax benefits because we are the 501c3. That's how they get all those benefits. So it works pretty much like that. It's pretty simple. In a moment, I'll talk to you briefly about a couple of the asset types listed here, and we can see how we might be able to utilize some of these to benefit our clients. Here's a flow chart of how it works. I always feel like that's kind of good. Now, how does this thing play out if I actually have a client that has a case that looks like it might be suitable for this? Then how would it work? So obviously we would do the case design, make sure it's beneficial, suitable for the client. If it is, and we move forward, the client transfers the asset to Legacy Tree Foundation. We simply issue a contract in return. It's pretty much just that simple. That contract is going to include what the tax deductions are, whether they're income tax deductions, capital gain reduction, estate tax reduction. And then it's going to also talk about the terms of the income, whether it's immediate, deferred, term certain, or lifetime. So it's pretty much that simple. On our side of then the equation, because we're promising a long-term income to the client, we're going to reserve the funds for the value of that future income stream. And so in our case, instead of investing those reserves into something that's going to be potentially volatile, we simply invest in an annuity contract from a highly rated and familiar insurance company. And then when the time comes for the income to start, whether it's immediate or whether they defer them, we're typically going to have the money be paid directly to your client on our behalf from that insurance company. We found that tends to add a lot of peace of mind for the folks involved. A lot of advisors like that, a lot of clients like that it's going to come from the insurance company that we use to ensure that future income. And then of course, the reason any of these benefits are available is because it's a charitable plan. And so we allow the client then to recommend a charity to benefit from their transaction, and they get to participate in that charitable component and make recommendations for charities that they would like to see benefit. So that's the gist of it. We really have two plans that we talk about. They're basically the same other than how the client likes their income. One on the left is a term certain legacy plan. We use that over 90% of the time because that is a specific term of years. So a lot of people pick that to pay beyond their life expectancy, expecting that the kids will get some sort of an inheritance from those continued payments. A lot of folks actually start the payments or want them to start upon their passing, so that when they pass away, then the kids are going to get an income for 10 or 15 or 20 years, however that folks want to set it up. You can see the IRS codes written there. And then on the right side, that's a charitable gift annuity. I'm sure many of you have heard of those. They've been around since 1843, so they're not a new concept. And that's different in that only basically that the income gets paid for the lifetime of one or two individuals instead of the term certain. Some people like to use that in a scenario where maybe they're going to fund life insurance. And so maybe it's even a couple, and we put the insurance on the or put the legacy plan on the dad, for example, and maybe he can qualify for life insurance, and so the income gets paid at a higher rate when it's one person, and so we can get more life insurance when he passes away. Then the income goes to the spouse and or to the kids, depending on how they like to set that up. So that works very well in those scenarios. The one thing again that makes these different than just an annuity type of program in your world is that number one, these two programs can be funded with assets other than cash. So I mentioned cash, real estate, securities, annuities can fund these types of programs. And because we are a 501c3, then that's why the tax benefits are involved, which is why we're having our conversation today. But also keep in mind, just to eliminate any confusion, these are not charitable remainder trusts. A lot of you are familiar with those. Those are good planning scenarios, but these are simpler than that. These are just a simple concept where the client exchanges the asset with the charity. The charity gives them a contract in return, kind of like when you write an annuity with any other company, except as I mentioned, we're a charity, and so there's those added options that we have available. Now, I mentioned earlier that 4 popular asset types that we usually see being used to fund these charitable plans. So I want to take a quick look at some points regarding some of these types of asset transfers and what to look for as possible suitable scenarios for your clientele. Because many times charitable plans are executed, and I've alluded to this, because of some potential looming problems with existing assets. As we know, most assets are going to perform as expected during the accumulation years for your clients. But however, then when it comes time for the income years from those assets, or maybe the distribution years, or at a time when they want to pass the assets to the heirs, then they can, in a lot of cases, become problematic. There's problems associated with that. Like cash, for example. I mean, they're great assets. Who doesn't want to have cash? But you got low interest rate on cash typically, and what you do have is taxable. So that's, maybe there's other options that might be beneficial for your client. So the client you want to look for really is the client that thinks they're paying too much in taxes, and who doesn't think they're paying too much in taxes. But if you have discussions with your clients about tax reduction, they might like to know about these ideas, because they're probably, there's clients that have the lazy money, we call it, funds and CDs and money market accounts that aren't gaining a whole lot. And again, as you know, those gains or growth in those cash accounts are taxable. And so this could be the perfect asset to use to create that tax deduction. You might think of clients that have had, sold real estate or a business or cashed in a qualified account, and they've created for themselves a tax issue that they have to deal with. And so transferring cash to create one of these deductions can be a sound year-end decision for them to make. Some people are paying tax on RMDs. They don't want to even take the RMD, so this is a way that they can maybe offset some of those. A lot of people want to provide to charities, but just can't afford to give the asset away. So this is like what I talked about. They could transfer some cash, create a tax deduction, could help some charities, and at the same time get all their money back over a term of years. A lot of people like to just do these types of cases to create a structured inheritance for their heirs. We've done several of these where mom and dad didn't want their kids to inherit a lump sum, or maybe the annuity where they could just cash it out. So these programs work really nicely to lock in that structured payout to the heirs while benefiting from the taxes and the philanthropic aspects now. And if you have high net worth clients, maybe they've exhausted all of their retirement planning options. And so this could be an additional way that they could put some money aside, get some tax benefits now, and then create an income for themselves at some point in the future. Securities, that's another one that we run into a lot. And there's some issues along the way that securities or high risk type of assets can have. The market volatility is a big one. Obviously, growth is going to be taxable because of the capital gain. And then, of course, you have the risk mainly of getting the current value to the heirs. That's probably the biggest thing, especially when your clients start to get a little older. They don't want to have as much in the stock market. And so the main person you want to look for is for that person who wants to reduce exposure in the market risk that they have. And so these are people who want to just, or maybe should be out of the market, simply want to get off the market roller coaster. A lot of folks, especially seniors, they're happy with some of their growth in recent years with some of these riskier type of assets, but now, who knows with the volatility and all that stuff, and they don't need the market to correct itself in their lifetime because they don't have that much lifetime left in order to catch up on that. So this is a good scenario for that, because a lot of people have these types of assets they'd like to liquidate, but they don't. They hesitate because of the capital gain issues. And so this is a great scenario where they can transfer the asset and they get the income tax deduction, but they also get the capital gain reduction. And some people like to do this because they would use that income then to fund life insurance so that they can replace that value to the kids more tax efficiently. Now, I know they get a step up in basis on these, and that's a great benefit, obviously. But if there's the risk of the market tanking and it goes down 20 or 30%, then the value that they wanted to get, even though they might not have the capital gain taxes via the step up, they still lost a lot of value. So this is just a way that if people want to feel more comfortable, they might be able to get out of those assets and use this type of program to fund life insurance or something like that. Now, remember, we're not a broker dealer or financial institution, so we don't give securities advice. So that's up to you to make sure that you're properly licensed if you do give securities advice. And then also, it's important for us to mention that these are legacy plans or charitable planning programs, so they're not investments, and they shouldn't be represented as investments for the client. Real estate's another one. It's similar types of outcomes on the securities because it's a capital asset or an appreciated asset where there's capital gains involved. But it's the same thing. If you have clients that own investment or rental property, second homes, they'd like to reduce their taxes, they want to get out, but they don't because of the capital gains, then this is a wonderful scenario for that, because they get income tax deduction, they get capital gain reduction, and they get the income. And this is one too where a lot of people like to fund the life insurance to get that asset value to kids. And a lot of that has to do with geography, basically, because a lot of kids aren't where mom and dad are nowadays. And so when mom and dad pass away, kids got to, send her back to home there and try to figure out what to do with real estate. And so this is a great thing for mom and dad to be able to alleviate some of the hassles of what might happen after they pass away. In terms of this, because they could eliminate all the tax issues, or at least reduce the tax issues associated with this type of property if they sell it, fund the life insurance, and now the kids are going to be happy as can be to get life insurance instead of inheriting a piece of property. So that's a great scenario. You get compensated twice on this as well, because you get compensated on the legacy plan, but you also get compensated on whatever life insurance program you were to select for your clientele. And the last one I want to talk about is the annuity, and this is actually the one that we see happen the most often with annuities. And so what we're looking for in regards to our clients with annuities is clients who have done well on annuities. Annuities for us are typically our most popular strategy. You all know they're a wise planning tool. I know a lot of you have done a ton of annuity business. There's something like $2 trillion worth of annuities in force. So we know, you know, how valuable annuities can be for income tax deferral, and retirement planning, income planning. The point being here that if you have a happy client, you're in a nice position to talk about the future of that annuity and what they plan to do with it, because currently less than 5% of folks actually annuitize their annuities. And so it seems that a lot of folks, and this is another good point of a client that you might want to look for, which of my clients is planning on passing that annuity to heirs? Because when they pass to the heirs, what happens? The kids inherit the gains or the growth in that annuity, and now they have to pay taxes on that. It's considered an IRD asset, and so the kids inherit the taxes as well. Annuities aren't necessarily the best asset to use to transfer wealth. So of course, mom and dad, they're going to be concerned about passing a taxable event on to the kids. And so if we can use a legacy plan funded with an existing annuity, it might just very well be a more suitable and beneficial way to get that annuity value to the kids more tax efficiently. Of course, as always, there's an income tax deduction. And so in this case, it's going to offset that 1099 gain within that annuity, and also hopefully and ideally reduce their tax bill also. And so, a lot of families like to do this because they would like to, again, provide that structured inheritance. So when the kids inherit the annuity, they don't just lump sum it out, but they actually create an income for the kids as well. A couple of things to think about in terms of annuity clients, and don't want to insult your expertise here, but a couple of quick thoughts on questions that might, introduce this concept. These are your clients anyway, so it's probably not a big deal, but do you think you will access income from your annuities? Most of the folks aren't, because LIMRA says less than 5% actually do. Some people take withdrawals, of course, but very few will annuitize that annuity. So are you concerned then about passing tax consequences on to your heirs? Most folks are going to be concerned about that. Would you like to create a structured inheritance for your heirs instead of giving them a lump sum? Maybe for part of their estate, they would like to do that. And then could they use the tax deduction now and have income available for themselves or their heirs in the future? Of course, a lot of them want to do that as well. So here's a quick scenario of how that would work. Rob and Irma, they purchased an annuity several years ago for $100,000. They wanted to put money away for tax deferral, potential growth. We all know how that works. That's the idea. In this case, it's now worth $150,000. So it's got a surrender value of $140,000. But to put 100 in, 150 value now, it's got a 50,000 in gain. They don't believe they'll use the annuity, but they're concerned when their children inherit the annuity, they might have to pay taxes on the internal growth. What they do, here's the same flow chart I showed earlier. So they transfer the annuity to Legacy Tree Foundation. We issue a contract in return. In this case, it's a 5-year deferred 20-year payout plan. They weren't necessarily planning on taking the income. They still can, but they deferred it till the time when they're going to pass away. And then when they do, the kids can get income for 20 years on this. And so what are they getting in that contract? Creates a $71,000 plus tax deduction. If they're in the 22% bracket, could put $15,686 right back into their pocket. The goal here is to be able to use the tax deduction to offset that $50,000 in gain in there. So this obviously can do that because they have $71,000 available. So we can settle up with Uncle Sam on that, so the kids don't inherit the lump sum tax attached to it. And then they've got an extra $21,000, so it can also just reduce their general tax liability. So that works very nicely. Remember, we don't give tax advice. We're not tax professionals. So in the case with your client, make sure to have verified that information by a tax professional. Then, of course, they're going to get the income that starts in 5 years. And so the Carters or their heirs are going to get $82.20 a year for 20 years. As mentioned, most parents don't plan on taking the income, but they still have the ability to access that if they want, or they can name their beneficiaries. Or they can set this up as a structured inheritance. And then we're promising income, so we're going to insure that and invest that into a highly rated and familiar insurance carrier. Payments will go directly to the clients from the insurance carrier most of the time. So the tax and income benefits, $180,000 plus. Now this is important to consider, these 3 points. Some of your clients are never going to access this annuity, and they would like to avoid passing the taxable event on to their children, and they could benefit from the tax deduction this year. So that's why we like to talk about the annuity strategy for your clientele. What's in it for you? It's a 7% referral fee. We can offer it to clients that are any age, and the comp stays the same for every age. So this is just simply the model that we've, the compensation package that we've entered into our model. A lot of charities do different things to raise money, fundraisers, golf outings, banquets. I know you've all been to some of those things, but we just think you've done the work, help clients save on taxes, perhaps increase their income, help get money to support charitable work that probably never would have gotten to a charity had you not helped your client. You should get paid for that. The reserve method, and that's the, we call it reinsurance, but it's actually a reserve method, how we reserve the funds. And again, we put those into highly rated insurance carriers. We could self-insure that, put the money into investments, do things like that. But we just feel it's a lot more efficient. It's a lot more secure to put that money into the insurance plan that's going to go to your client. So we put 100% of the future income, the present value of that future income, into an annuity policy. And so it basically guarantees that income based on the claims paying ability of those insurance companies that we select. And pretty much every company we've used, I think we have like maybe 31 companies we've used so far to insure different programs, but you've probably heard of just about all of them. And then the other thing is that the clients can recommend charities that they would like to see benefit. So that's a nice benefit for you in making a presentation of this type, because it gives the client some flexibility on the charitable component. When they learn that, well, how do you do these tax benefits? It's like, well, it's because it's a charitable program. Then they're like, oh, well, I'm kind of interested in, helping my church or the teen pregnancy center, or the homeless shelter in town, or the animal shelter, whatever. And so then they can make recommendations to those charities to participate in that charitable component. Legacy Tree Foundation, again, is a 501c3, been around since 1999, so we're about 20 years out there. We're a Christian faith-based charity. Our mission is to provide spiritual, physical, and humanitarian aid to those in need. So that's what we do as a charity. We have some specific charities that we support, but again, we also allow your client to participate in that charitable component. So as mentioned, again, if they're local church, homeless shelter, food bank, college, Wounded Warrior, St. Jude, some of those are something that they would like to see benefit, then they can recommend those charities. And that, again, that gives you some flexibility and control with your clientele. A couple of last points here. Who are the primary beneficiaries? Right now, it appears that in most cases for people, the primary beneficiary is the IRS. We like to call that the involuntary philanthropy, or maybe the uninvited beneficiary. The family second, and then charities are last. And so what we're trying to do with this type of an idea here is to reverse that a little bit, so that the family can be the first to do what the folks want to do with their money, and then they can have charity do things, which would be their second choice, and then the IRS would be the final one in this type of planning. So a couple of quick points in summary. You no doubt have some clients who could or would like to reduce their tax bill, probably. Some have to take RMDs, some have done Roth conversions, some have sold assets with tax issues. And so charitable programs can be structured to help in a lot of these cases. If you have the securities clients or the real estate where they have the appreciated asset, these are wonderful scenarios to offset the gains in those, in addition to getting the tax deduction. And then the annuities that we talked about, I know that a lot of you, that can be the main part of your business or a big part of your business. And so we usually talk to folks about the book of annuity clients that you have now, because this is a case where, maybe you sold an annuity 10 years ago and it was the perfect scenario, and it still is, but now you have folks that are in their 80s and they're like, well, now they're not sure what they're going to do with that annuity, but they're concerned about passing the gains on to the heirs. And so this can be a great scenario to offset that. A lot of cases, you don't really have many options there anyway, because it can be unsuitable to try to move somebody in a higher age group to another charity because of new surrender fees and those kind of things. And so in our case, that's a good benefit for you, because one, if it's suitable, beneficial for the client, then that's a good scenario. But also, we don't reduce the comp for you, and we can still pay the same comp regardless of the age. So if you're looking for a way to be able to increase your production without having to add new clients, then that's why we think you should consider these programs. And the reason is because most of the cases that we do here are done with advisors like yourselves, working with your current clients with their current existing assets. And there are a lot of times assets that are left on the table because you may or may not have known about these types of planning tools. So really, in the end, this is just a simple way to keep the IRS from being a major beneficiary, part of your client's nest egg. Because if you're able to reduce or resolve the issue of passing tax to the children, provide additional tax savings, when is that not a popular discussion with your clientele? And certainly could be a new reason to communicate with them, or a new topic to talk about when you have your annual reviews, because there really aren't that many options where you can get this much tax advantage and income, all while helping those in need. And so if any thoughts here have spurred any thoughts of clients, or maybe you're thinking of some specific, I got a client that's got this particular asset or that particular asset, obviously you can call 5Q group there, talk to Jerry, that the number is listed there, but you can also feel free to call us directly. You're probably in our database. If not, we'll put you in our database connected with 5Q there. And then John Frazier will be able to assist you, talk about case design, go over the details of if and how this might be beneficial, make sure it's suitable, make sure we're providing the proper disclosure points for you, and then give you the talking points and help you present that for your clientele. So that's all I have to say at this point. Jerry, Mike, I don't know if we have questions or where you want to proceed at this point, but I'll say right now, thanks for letting us share the ideas. We hope this has been beneficial and can be useful to benefit clients as well as the advisors that you'd like to help.
Yeah, well, thank you very much, Jim, because we're always looking, guys, to look different from all of our competitors. So this is a great way to do that, have a solution for problems. Taxes is a huge problem that they have not thought about or have not been shown. So I do have one question here. Let me read it. I haven't read it all the way through. It's kind of long, so let me just, I'll read it as I see it here, Jim.
Yeah, sure.
How does the transaction overcome the fact that legacy plan internal costs have been paid out of the insurance company's annuity through the tax-favored properties of the nonprofit wrapper? Provide client greater benefits rather than going direct with the insurance company for an income annuity with a higher payout.
Yeah, that's good.
That was a long question.
Yeah, I think I get the gist of that. I mean, that's a good question. And that's what we do with the case design, really, is because there's two variables. One is, are they looking for just income? And I will say this, if you have a client that's just looking for the most income possible and that's their main goal, most of the time we're not going to be able to compete as well because part of the asset that they're using, in our case, part of that is the tax deduction portion. And so we're starting with a little lesser base in order to start the income. So the income can be less, but that needs to be compared then with the charitable component to see what the benefits and the ramifications are of that tax deduction, whether it be tax deduction or capital gains. Because a lot of people say, well, maybe I could just do a $500,000. Maybe I could just make a $20,000 donation, buy an $80,000 annuity. That's going to be very similar, except that in our case, we're able to probably take that same $100,000 and give them a $40,000 deduction, so they get twice the deduction, and then the income would be about the same. In that case, starting with a little lower number. So, but the deduction could be, set up in such a way that maybe that is just as beneficial as the income side. So that just comes into play when we do the case design, because yeah, that is a great question. We have to make sure it's suitable, making sure it's meeting the desires of that client and the goals of what they want to accomplish, both on the tax side and on the income side. So that's a good question.
Perfect. Other questions, guys? You guys must have done a good job explaining, Jim.
Quiet today.
Well, hopefully it wasn't.
No questions. Sure, guys?
Yeah, hopefully it wasn't to the point where it's like, that's too much information. But really, that's what John's here for. John is excellent at being able to.
No, we're getting a lot of. Oh, okay. First of all, I'm getting a lot of people saying it's a great idea, and thanks for sharing it. And then that they're going to be reaching out to Jerry or yourself. A few of them said they have too many questions. So thank you for guys that have too many questions to not do them here. Yeah, the best thing to do is actually call Jim. You said to call who again at Legacy Tree?
Yeah, you can call John.
Who's their contact there again?
John Frazier.
Yeah.
The number's there, and his extension is 7015.
7015.
There's John.
Perfect.
And if you got a lot of calls,
and then calls in there today, John would be happy to answer all their questions. Yeah,
that's correct.
Good. So yeah, give John a call. Again, give me your extension one more time, John.
7015. So the number there on the bottom right, and then extension 7015.
7015, and you'd be willing to sit down or on the phone and answer all their questions that they have.
I'm sitting down right now, so bring it on.
Yeah, and Mike, if they've got quite a few folks that are going to, if you got quite a few folks calling in right away, they can go to my extension for now. Also, just so they're not like having to wait, because if we get 4 or 5 people, there's only one John. But there's a couple of us here that can take some questions too if there's immediate calls right now. My extension is 7012, so they can do that, or they can just press 2 on our phone, and that'll get them someone else. Make sure they say they're with 5Q though, so we can make sure that so that we have them in our database affiliated with you folks.
Super. So it looks like you guys enjoyed this call. A lot of you have additional questions. You'll be reaching out to them. And again, guys, it's just a way to look different than everybody else. I would go through your head and your database and think, who would this be? Do I know anybody that this would be good for? Do I know anybody this would be at least worthwhile walking through or bringing up to them? So if you've got additional questions, call Jim, call John, and they will both be willing to help you out. And it says, can we, okay, another question here. Can we get tax savings illustrations sent to us? So is that part of the process, or?
Yep, absolutely. That's what the conversation would entail. We can go over details. But when we get down to the basics, you know, it's like, well, all right, let's talk about this client. And so then we start getting the numbers. You know, they've got this asset, this money, this, you know, their tax bracket, and we'll run an illustration. It's a nice illustration, and that'll show you the tax savings and you know, what that can do for the client within that illustration.
Super. So guys, think of somebody that you think this would be a good thing to address, and then reach out to Jim or reach out to John, and they will help you do that. So thank you very much, guys, for being on the call and sharing this great idea. And looks like you guys get an early call today, so that's good. You can get at it for the week. So I appreciate all being on the call, and then we'll talk to you all next Monday. Thanks, everybody.
Thank you all.
All right, thanks. Appreciate it, Mike. Take care, you guys. Jerry, Mike.
Thanks, guys.
You too, Missy. Thank you. Bye-bye.
Okay, bye-bye.